Good morning, everyone. This is Katie Novotny calling in from Premier Marketing. I want to thank you all for taking the time to join us this morning. Today, we are going to talk about taxes. Probably not one of the most exciting subjects, but it really is in long-term care planning. So I know a lot of people were calling me and asking me a bunch of questions on why we were doing this. Well, first off, it's Long-Term Care Awareness Month. But secondly, I think that there's a lot of benefits that we don't realize that are something that we should be sharing with our clients right now as they're planning for year end specifically. But as always, I mean, there's always some tax benefits for long-term care planning. So I will point out ahead of time, we've had a couple issues with audio. So if for any reason any of us would cut out, please feel free to type it in the questions section or any questions that you may have in the meantime. But just so we know that you can't hear us or if something goes awry, hopefully there's no more issues. But with that being said, we are thrilled to have Mutual of Omaha's team here today. Today we have Stephen Alloy, Amanda Blackburn, and Maria Lara Rivas. They're all going to go over a little bit about the opportunities that we have with long-term care insurance as a whole, and then specifically the tax benefits for your clients. So with that, are you ready to take it away, Stephen? Stephen, we can't hear you.
Oh, okay. I didn't know because you'd cut out a little bit too. Hey, thanks, Katie, and thanks everybody for calling in. You know, as Katie had mentioned, I think I just did there, but if I cut out, I'll just pause and repeat my benefits that are connected with long-term care insurance. I mean, there are a lot of good reasons to buy long-term care insurance besides the tax reasons, but in addition to those other good reasons, there are some good tax benefits as well, and the tax benefits vary a little bit depending on who the insured is, who's taking out the long-term care insurance. So let's take a look at what some of the tax benefits of long-term care are. Long-term care, of course, is covered under HIPAA, and under HIPAA is defined as accident and health insurance. So that is what that definition and that classification really is what qualifies it for some of the tax benefits. At least under current law, that providing this is not a taxable event to the employees. Has been some talk about changing that, but nothing's happened. I mean, there's been some talk about that for quite a few years, but nothing's happened yet. Hopefully it'll stay that way. But HIPAA is what kind of the framework for long-term care insurance in general and the tax benefits in particular. So what are these tax benefits? Well, kind of depends on who you are. They're different if you're an individual, a business, a C Corp or a non-C Corp. Those are kind of the two business categories, and a little different if you're an employee. So let's take a look at each one. For individuals can deduct up to the eligible premium of, based on their age. So these are age-based. Each decade, basically, they increase. I have the 2022 numbers, and the 2023 numbers have come out. As you can see, it is going up a little bit. Typically, it does go up. It hasn't quite gone up every year, but most of the time it does go up a little bit to adjust for inflation. So now the numbers that somebody would use for the taxes that we're going to find be the 2022 numbers, not the 23s, but the 23s would be in effect, for next year, and then those taxes would be paid in 24. The eligible premium is to their medical expenses. So they would have to itemize their medical expenses and then add this, and then they would have to have medical expenses that reached a total of 7.5% of their adjusted gross income. And then they could deduct anything above that amount. So they could add that eligible premium as a medical expense, as a way of, getting to that 7.5%. When I say eligible premium, they could add their actual premium up to the eligible. They couldn't add more than the eligible, but they, if their actual premium is lower than that, then they'd use their actual premium for the deduction. So that's basically how it would work with individuals. And essentially they would have to itemize their deductions on the Schedule A. This is an example of Schedule A. It's from a couple of years ago. We'll probably update it here with with a new one here for this year or for next year even. But problem is that most people, most individuals don't itemize. I think the majority maybe never did, but with the tax bill of 2017, raising the standard deduction, well, doubling the standard deduction, that really reduced the number of people who itemize. So now it's a very, very small deduction. On the other hand, if they don't have enough medical expenses, they wouldn't get the deduction anyway. So maybe they're not the sunset at the end of 2025, which I remember when this bill passed, that sounded so far off. That's a couple years from now, so it's really not that far off. But and who knows, anything can happen between now and then, or it could be continued after 2025. But as of now, that doubling of the standard deduction is scheduled to go away at the end of 2025, which what that would mean is that going forward, there might be more people itemizing and maybe able to make use of the long-term care deduction. For businesses, it gets a little better. And businesses basically fall into two categories. You're either a C Corp or you're not. So it's what is kind of lumped into the category of self-employed. So basically everybody is taxed from a tax standpoint, at least from a long-term care tax standpoint. You're either a C Corp or you're self-employed. So let's take a look at self-employed, because that is really going to be most of the business owners that you run into are going to be LLCs, S corporations, those type of entities where those are all considered quote unquote self-employed for tax purposes here. So with a self-employed business, they can take up to the eligible premium. Again, they'd take their actual premium. If it's lower than the eligible, they'd be limited to their actual, but they can take up to the eligible premium without needing to aggregate that as part of their medical expenses. So they could deduct that. It's very unlikely to be their only medical expense, but if it was, they could deduct it even if they had no other medical expense. So that's a nice little plus for business owners. It's taken off the income for the entity. It's done on their business tax return. It's taken off, and then they can deduct this expenses. And this is how it would work for the business owners, for the the self-employed or the pass-through business owners. C corporations really have kind of one of the best deals around as far as deduction in the insurance industry as a whole. This is probably one of the best ones out there. They can deduct their actual premium, and they can, again, without regard to aggregating. It can't be an absentee owner. It would have to be a shareholder who is an employee who is working in the business. But that's, most of the businesses that we run into we very rarely run into an absentee owner. Most of the time the owner's, very, very involved in the business. So that's usually not a problem. But it can cover that owner. It can also cover the owner's, the shareholder employee, I should say, spouse and dependents. So if they've got dependents and again, this gets a little tricky because technically a dependent, you have to provide more than 50% of their support. But, if you did have a situation where, the C corporation owner was doing, business owner wants to provide the, doesn't want to offer it necessarily to everyone. So employees with long-term care can carve out a class of employees with a lawyer who understands ERISA, so that they don't run afoul of ERISA. Because if they run afoul of ERISA, then they're back to, they got to work with an attorney that can guide them through this, so that they don't run afoul of that. So for employees, now if you're not a business owner, you're just an employee, and the business is the business is providing long-term care insurance, this might be, you know, the best of all. I mean, any business structure, if it's a non-owner that's receiving the long-term care, the business can deduct the actual premiums for that employee, the spouse, and dependents. The employee is under current tax law, that employee is not required to report that as income, and the benefits still arrive tax-free, you know, if they go on claim. So typically no out-of-pocket cost, no taxation, tax-free benefits. Really didn't get a whole lot better than that. So that's probably the best of that's really the tax trifecta there. That's really probably the best of the tax situations. So again, long-term care benefits, as I mentioned, and as I'm sure you all know, typically are income tax-free, but they're income tax-free to the extent that they don't exceed actual expenses, you know, qualified long-term care expenses, or if you've got a reimbursement, you've got an indemnity policy, they can't exceed the per diem amount, which for this year is 390. Next year that goes up to 420. So that's roughly, it's right around 150,000 for the year. This year it's 145 or 46,000. It's a little bit less, but it's close to that. So as long as the indemnity or the benefits from long-term care don't exceed that amount, then they wouldn't be taxable. To the extent they exceed that, though, anything above that would be taxable. So there are some other tax considerations here too. Can you pay long-term care insurance premiums from a health savings account? Yes, you can. There are some restrictions if on HSAs and HRAs if it's employee paid versus employer, but short answer is yes. Yes, you can. Can you pay eligible long-term care premiums from a medical savings account? Yes, you can. Can you pay from a health reimbursement account, HRA? Yes, you can. So that's all good news. The less good news, you know, can you pay from an FSA? No, you can't, unfortunately, because that's, and same thing really with the 125 plan, the cafeteria plans. Can't use those funds to pay for qualified long-term care. Reason being that these are put in by the employee pre-tax, and you can't put in pre-tax for something that is going to provide tax-free benefits. Now, as an employee, you may think back a couple of slides like, well, as the employee, they kind of are. And they kind of are, even though, I mean, it's the employer's money that's going in and they're taking the deduction. The employee's not taking the deduction. But still, it is kind of pre-tax money going in, but that's really the one exception. In general, good tax rule in general, you can't use pre-tax dollars to get a tax-free benefit. And we see that here with the FSA and with the 125 plans. So can you do a 1035 exchange from a life or an annuity to a standalone long-term care? Yes, you can. Pension Protection Act allowed for that, made that, I think the act originally passed, I want to say like 2006, wasn't effective really for a couple of years. I think 2009 might have been the first effective year. Changes from a life policy or an annuity. Now, unfortunately, it's allowed, but it might be very difficult to find a carrier that would do it. One of the problems is that, you know, if we had a lump sum, a single pay long-term care policy, that might be a little bit easier. But with lifetime pay, it's not clear from a tax standpoint, not clear to the carriers whether that's a legitimate 1035 if you do a bit at a time over a period of years. Back in, since 2009, so we still don't really know. There are maybe some work around that I know quite a few people have done is they'll do a 1035 into a SPIA, and then they'll use the SPIA payments to pay the lifetime, long-term care. So the SPIA payments are going to be taxable. There will be a tax, but there'll be an exclusion. Typically, there'll be an exclusion ratio on that based on whatever the basis of the life or annuity was. So some of that won't be taxable. So that might be a workaround for in a lot of cases. So return of premium. Generally, return of premium is not taxable, not considered taxable income to the extent so if you've got individuals, let's say, who have a return of premium long-term care policy, and they never itemized, they never deducted it, well, then that would not be taxable income to them because maybe they just took the standard deduction and go pre-tax and then get a tax-free benefit, which the return of premium in general would be a tax-free benefit. So, to the extent that it hasn't been deducted, that is still tax-free, but if it's deducted, that would be taxable. Nice provisions of the gifting rules is, of course, you're limited on gifts. This year, that actually is going to go up next year to, I think, 17,000. And then, of course, there's a lifetime gift that's very large, in fact. But you can actually gift limit. You're not limited to that. This year it's 16,000. You're not limited to any of that. So you can pay it on unlimited. It's got to be paid directly to the provider. If it's actual medical care, it has to be paid directly to the medical facility or the doctor. For premiums, it has to be paid directly to the carrier, to us or to another carrier. And then only the eligible premiums. So if the actual premium is higher than the eligible, you'd only get the eligible exclusion. But it's still a pretty nice provision. These benefits I've talked about are really all federal tax benefits, but we've seen some states that have some pretty nice state tax incentives, in part because if you think about it, the states really have an interest in people paying for their own long-term care because the state really is the one that winds up picking up the Medicaid costs. So a lot of states have said, hey, it's worth a lot to us to make sure that we keep Medicaid costs low. And so we're going to give, some states income tax, they may not have as many incentives, but those states that do have state income tax, some of them have some pretty good incentives of long-term care insurance, and see what state incentives are available in whatever states you're working in. And speaking of states and speaking of ways that states are looking to minimize that Medicaid expense, a lot of states are looking at doing what Washington State did. I'm sure you probably have all heard about the Washington State law. It passed here and was half months or so from now. I just think it's interesting that literally in between, so it's literally the same people that had just passed this law voted 91-6 to hold off on it. I think maybe they realized, we left a few things out, and they did. I don't want to go into too much detail. I got another presentation I could talk about on that, but this is something to keep in mind, I think, as you're working with clients, that whatever state they're in, and some states are kind of down the road already on looking at doing something like the Washington State law. But I really think in the next handful of years, just about every state's going to do something. And some of them are going to look like this, some might look a little different, but every state has the same Medicaid problem. Even states that don't like taxes. Literally, there's North Dakota probably doesn't like taxes as much as any other state doesn't like taxes, and they're actually looking at doing something. So, I would really encourage you to get with clients, in relatively sooner rather than later, because I think over the next handful of years, next 3, 4, 5 years, we're going to see a lot of states doing this. And one of the nice things about the Washington law and most of the others that are out there, is they allow people to exempt out of this tax because it's basically funded with a payroll tax. They allow people to opt out of that if they've got long-term care insurance in place. So to the extent that people can get that in place soon, then they'll be able to opt out whenever their state decides to act. So something to keep in mind, I think, when you're meeting with clients. If you've got, and this may not come up, excuse me, may not come up that often, but if you've got retired public safety employees in your client base, earlier about not being able to use pre-tax dollars for a tax-free benefit, that's almost always true, except here. And for this, they can actually take $3,000 that was put in tax-free, put in pre-tax, and long-term care insurance. Now, again, it would have to be paid. It can't be distributed to the individual, to the retiree. It's got to go directly to the carrier. But that's a pretty nice benefit if you fairly limited range of public employees, but it covers if you have tax benefit. Partnership program, I'm not going to talk in a lot of detail about that, just in the interest of time, and also you guys probably know more about how that works than I do, but it basically lets it's sort of an people with tax qualified policies protect. That's why the states got involved in this to begin with, and really it's why they're looking at other solutions as well. But it's a nice way of protecting assets. As against, if you do wind up having to go on Medicaid, it would at least you'd be able to shelter some assets as a result of the partnership program. So with that, and again, I apologize for the sound cutting in and out, but if anyone has any questions, maybe type them in, and then we can answer them, or certainly feel free to contact us or contact Amanda Blackburn, who I know is on the phone here. Maybe contact her or contact any of the people at Premier. We'd be glad to answer your questions, glad to help you work on cases as well. So I don't know if there are any questions, Katie, but other than that,
Stephen, thank you very much. I do know
thank
that
you all for attending today.
Yeah, we were having some audio difficulties, and I do apologize. Like I said, I was hoping that we had cleared them up, but what we are going to do is we are going to see if Stephen would be gracious enough to re-record this for you.
Oh, sure.
Yeah. A couple people have asked, saying that they really were interested in the topic, but it kept cutting out. So with that, what I think we might do is just let's cut this short and figure out a good time to re-record. And as he said, any questions, feel free to give us a call here at Premier. If we don't know the answer, I am sure that Stephen and Amanda would be more than gracious to help us out on that. So with that being said, thank you again, everyone. I really appreciate it. Again, my apologies on the audio, and we will get something out to you shortly.
All right. Thanks, everybody.
Take care.
All right. Thanks.